I'm gonna break down the basics of what options trading is. Yo, what's going on, all you beautiful people out there on the internet? It's your boy, David Osborne. I've been investing for about 4 years, and my typical strategy, just like most people who are novices in investing, was buy and hold the stock. I would buy 3 or 4 shares of Apple, which would cost like $600, and I would just hold it and pray, hope that it goes up to, $250 a share. And then my $600 is now worth $1,000. Currently, I'm more leaning towards swing trading myself. For those of you who don't know, swing trading is buying a stock, let's say Amazon. It costs $3,400 today. And tomorrow, it goes up to $3,425. So I buy it today, assuming that tomorrow or the next day it'll be worth more. And when it goes up, I sell. When it goes down, I buy. When it goes up again, I sell. So I just kind of follow whatever the pattern is of Amazon. Options trading. I'm new to this, but I'm going to try and explain it to you as best I can. I think sometimes when the experts get so far along in it, they use all these terms that it's just like strikes and candlesticks and put points and da-da-da-da-da, and you're just like, what the hell are you talking about? So I'm going to try and explain it really simply here. What is options trading? I've got Apple pulled up here on my screen. Not that matters too much because we're not going to get too deep into like chart analysis and things like that. We're just going to go with the real basics. Like I said before, I've been swing trading lately, which means I actually buy the stock in its entirety and wait for that stock to go up a little bit to whatever my target is, and then I sell it. I buy 5 shares of Apple at $400 a piece. So I spend $2,000 and I wait for 24 hours or maybe to the end of the week, and that $2,000 goes up to $2,200 and I sell. And I've made $200 profit that week, or in 24 hours, I made $200 profit. So that's swing trading. Now, options trading is cool because what you're doing, instead of actually trading the actual stock itself, you're buying a contract that gives you the right to buy Apple at a certain amount, a predetermined amount. So what that looks like is this. I'm gonna put the microphone down. Hopefully you can still hear me. Okay, so our stock is Apple, which is AAPL. When you trade options, you have to buy 100 shares at a time. So that's how they sell the contracts. So 100 shares of Apple at, let's say the current price of Apple, let's look at it right now actually, it's $135. So let's say we buy an option that says in 3 days, I will buy Apple for $135. Now, the person will sell you this contract for what is called a premium. So the contract could be, I looked it up before this, and it was $5 per share. So 100 times $5 per share, that contract costs you $500. Now, let's say in 3 days, Apple does what it's been doing over the past couple of weeks. And let's say in 3 days, Apple goes up, for example, in the past week, it's gone up 8%. So let's say Apple decides to go up 10% over the next 3 days, which could very likely happen in this day and age. So it goes from $135 to $148.50 in 3 days. So you can exercise your contract that you purchased. So the difference between this is $13.50, right? That's because Apple went up by 10%. That looks funny. 10%. It's because Apple went up by 10%. So $13.50 is the difference between what you are able to buy at and what you're able to sell at. So now you've just earned a profit of $13.50 times 100 shares. So that would be $1,350. In 3 days, you've earned $1,350. It's pretty good. Now, what did you risk in order to earn that? Could you have lost $2,000? Could you have lost $5,000? Because what if Apple went to 134 or dropped to 130, like, and then you had to buy it at 135. No, that's not how options work. What happens is this contract, you have the option to do it, but you don't have to exercise that option. You can just let that contract expire. And what will happen is you'll lose the $500. So the person who actually sold the contract will earn this if you don't use the contract. So your maximum loss in this particular scenario is $500. And your upside is unlimited because Apple could have gone to $175, which would have made your profits ridiculous. But let's just say they only went up 10%, which is really good in 3 days, but your upside was $1,350. There is still some risk. You could still lose. I don't want to say that it's foolproof or that it's easy money, because sometimes Apple will go down and you will lose the $500 premium, or Apple just goes up by a little bit and hey, you still won, but you risked a lot for that little win. That's basically options trading. I think I'll make another follow-up video to go into more explanation, but I want to give this other scenario as well. Again, we're going to stick with Apple. It's a very popular stock out there. Let's say you've got $1,350. At the current price, you could buy 10 shares of Apple. And let's say Apple goes up by $5. How much will you have earned? You will have earned, that's right, 10 shares times $5, you will have earned $50. And now maybe you want to sell it and take your $50. But let's say you took that $1,350 and you bought 2 contracts that I mentioned previously. So you risk $1,000 because the contracts cost $500. And now you have control over 200 shares of Apple. And let's say they go up by the $5. So now the 200 shares of Apple times $5, you will have made $1,000. And you've risked $1,000. In this one, you're risking $1,350, but more than likely, Apple isn't going to drop down to 0. But in this case, there is a chance that Apple drops to less than your strike point, which is $135. So this is riskier. This is options trading in a nutshell. I hope this video was helpful. I think I'm going to start to make some more beginner videos like this to explain some different things that you can do to leverage your money or to get your money working for you. So leave a comment down below if it was helpful and if you want to see more of these. Catch you guys in the next video.